What are market breadth indicators telling us about conditions here in late October of 2024? Hey there, everyone. Dave Keller with Sierra Alpha Research. So good to be back with you here on Stockcharts TV. I appreciate so much all of your thoughtful feedback and comments and suggestions over the years. Great to be sharing the show with you here today. Market breadth indicators are something, if you follow my work, you know are super important to me. I'm passionate about the different ways that we can understand the markets using the language of technical analysis. Market breadth for me is super valuable. And right after analyzing price trends and momentum, market breadth is key. If you want to get a read on the overall conditions, think about market breadth. Just a couple of quick announcements. If you're looking for my daily market recap show, it is back up and running. We've been going for about a month now, having a lot of fun. It's called Chart This with Dave Keller. You can find it on my YouTube channel called Market Misbehavior. I also recently launched a new Market Misbehavior podcast, just unleashed our 6th episode, I believe, at the end of last week. Talked with Mark Skousen, known as America's Economist, about a 50-year run on Wall Street and what he's learned and his market outlook. Some really thoughtful comments about hard assets versus paper assets and many other things. Peter Schiff with Euro Pacific Asset Management was my previous episode. That was another one that was pretty fun. Talked a lot about, the real value of money, dollars versus gold versus paper assets. A lot about non-U.S. versus U.S. stocks, China, precious metals, and everything in between. So again, check out my channel called Market Misbehavior if you're looking for that sort of content. Hopefully a lot of good conversations and analysis to help you navigate these uncertain times. When I'm looking at the chart of the S&P 500, I'm just reminded of the importance of price and trend. For me, it goes price, breadth, sentiment in terms of priority order. Price is most important. One of my mentors, Ralph Akampora, would tell me that if you know nothing else about the markets, know the daily chart of the S&P 500. And I took that to heart years ago as I was learning technical analysis and met Ralph for the first time. And I've not forgotten it. And to be clear, the first 2 charts I look at every morning are this previous chart, the weekly chart of the S&P 500, including my market trend model, which coincidentally, as of last Friday, is bullish on all time frames, and then the daily chart of the S&P 500. Everything after that comes, after any other analysis or views that I'm looking at come after that initial sort of appetizer for the meal, which is, understanding the market trends, understanding the market environment, focusing on the trend embedded in the S&P 500, and looking for signs that trend is exhausted. And that's really why I wanted to talk about market breadth conditions today, because I would tell you, even though the S&P has gone higher from August to September and September to October, this last move to new highs in mid-October, with the S&P kind of threatening 5,900 for the first time, is coming on weaker breadth conditions. Some of the breadth conditions that were actually quite strong in late September actually are a lot less strong here in late October. A month later, I would say the trend has remained positive, but breadth conditions are a little less positive. And as we get to the 5 different breadth indicators I'll share with you today, I'll talk a little bit about the value of looking at breadth indicators because they're equal weighted, right? The S&P 500, this chart looking at the value of the index is cap weighted, right? Meaning when Tesla is up 20% in a day, that's going to help the S&P. That's going to affect the price of the S&P in some way, right? When 5 of the Magnificent 7 stocks report earnings this week, that is certainly going to have a not insignificant impact on the S&P, particularly if there's big reaction after earnings. So what is the trend in the S&P? I would say clearly positive. My market trend model, as I mentioned, as of last Friday when I update it every Friday after the close, remained bullish on all time frames. That just tells me that the trends are positive, to overall assume that the market is innocent until proven guilty, but as always, be looking for signs of a potential reversal. I look for signs of trend exhaustion, which is something I've learned has treated me quite well over my career, recognizing when the picture has changed, what I call a change of character on the chart. So here's the S&P 500 making higher highs August, September to October, but even more impressively, I would say making higher lows. And so from that early August low, which is the last time the RSI was anywhere near oversold territory, we made a higher low in early September around Labor Day. We made a higher low in the first week in October, and now we've made another potential higher low here at the end of October. So as we look forward to a busy earnings week and then elections the week after the November Fed meeting, can there be any more potential catalysts for market movements in the next couple weeks? I'm not sure there could be. what are the conditions? So I would say we are sitting right on the trend line, right? And I find when trend line, the bolder that I make trend lines, right, the bigger the font size of the trend line, right, the bigger the weight of the trend line, the more important it is in my opinion. And so this is a big one, this big thick blue trend line, because it connects the August low and the September low, and it lines up really well with the late October low. And I think that's important, right? When you're drawing trend lines, you draw it with the first two lines, ideally, right? You have two lows, and then you project the trend line forward. And so we first drew this trend line kind of back here in mid-September when we established that as a higher low. It's like, all right, this is the trend line to watch. And so weeks later, the fact that we came back to that same trend line and found support, I think tells you something. I think tells you something about this being a pretty good representation of the pace of this advance over the last couple months. And I would argue it's most likely going to give us a pretty good indication, a pretty good signal of when that trend is reversed, right? And so again, the trend in the S&P is strong. We're making higher highs and higher lows. So as far as this chart is telling me, there's not a lot of reason to be concerned until and unless we start breaking down through support. And so I would say that breaking down through that blue trend line would be that initial signal that maybe this uptrend off of the August low is maybe changing. And then I would also say 5650, as I've mentioned on my show a number of times, chart this 5650 is kind of the level. That's the line in the sand that I'm watching, because if and when we would break below S&P 5650, that would mean we've broken down through trendline support, we've broken down through an ascending 50-day moving average, we've broken out through the pivot point from the July and August highs that became support in early October. We would have cleared all of those things. And if we're breaking all of those levels, this is no longer an uptrend, or at least not the same uptrend that it was coming off of the August low. So there's sort of the general, I would say, backdrop to this discussion on market breadth. Is the trend overall is positive, but I think we have a clear, indication, or a clear levels and signals to watch for that would tell me at least that the trend is reversed. So what I wanted to do today was dig into 5 different market breadth indicators. And to do so, I'm going through some of the charts on my Market Misbehavior Live chart list. We'll put a link in the description so you can access that chart list. If you're a Stockcharts member, which you all should be, of course, you can actually save any of these charts to your own login. You can edit them. You can add stuff. You can take stuff away, whatever you want. You can make them your own. If you're not a Stockcharts member, you can actually use the URL, just bookmark that, and you can see live versions of the charts. Again, I'm a huge fan of the Stockcharts platform, and the capabilities that you have access to at an incredibly reasonable and, if not underpriced cost for the value that you're getting. I'm a huge fan, so I hope you consider becoming a full member and join the Stockcharts family. All right, so we're going to look at 5 market breadth indicators, and we're going to start with arguably the most basic. These are the cumulative advanced decline lines, right? So advanced decline data is pretty widely, mentioned in the markets, particularly on an individual trading day, right? At the end of the day, you have so many stocks that closed higher and so many stocks that closed lower. So you have a what's called the advanced decline number, right? And this is reported on a lot of brokerage platforms, some financial media. They'll often talk about the advancers, decliners at the end of the day or during the day, just to show sort of the general trend of how many stocks are up or down. But the real value, I would say, is when you string those daily readings together and create what I'm showing here, which is called a cumulative advanced decline line. Here we're actually looking at the trend in advancers, decliners over a period of time. Every day we're just keeping a running total. If advancers outnumber decliners, that's added to the total amount. So you take advancers minus decliners and then add or subtract that from the running total. And so on up days, you tend to have more advancers. On down days, you tend to have more decliners. And over time, you have a pretty good sense of the trend of the advanced decline data. As I mentioned earlier, this is an equal weighted measure. So it's not like Microsoft is worth any more than Kroger or Fifth Third Bank or any of those other S&P 500 members. It's 500 stocks, and it's how many of them went up, or depending on what line I'm looking at, or it's the entire NYSE or the small cap index or whatever we're looking at. It's how many were up, how many were down, and that's it. And so because the S&P 500 itself is market cap weighted, the fact that the S&P keeps making new highs could just be the biggest stocks are doing fine. And if people are selling out of the really speculative stuff, but piling into Microsoft, Apple, Tesla, Amazon, and Alphabet, the S&P and the NASDAQ are probably still going to be at least, hanging in there, if not going up a little bit, while the breadth indicators are going to go down because that is equal weighted. And so the stocks going down are going to outnumber the stocks going up. This first indicator, I would argue, is not really showing that yet. It actually is confirming the uptrend that we've experienced so far on the chart of the S&P 500. From the top to bottom, we have the NYSE, the New York Stock Exchange, so it's looking at all the listings on the NYSE, and it's only looking at common stocks, by the way. It's ignoring closed-end funds and other sort of things that are listed on the NYSE, and overall, continuing to make higher highs and higher lows. Did make a new all-time high about a week ago. We're remaining above an ascending 50-day moving average. The large cap S&P 500 breadth, the mid cap S&P 500 AD lines, all remaining above an ascending 50-day moving average. Should note, by the way, these are updated as of Friday's close. These are updated every day after the close. So Monday's reading will be later today that those will be locked in. The bottom one, though, you can see that the small cap 80 line is actually, technically below. And on Friday's close, we actually went below an ascending 50-day moving average. And that's usually what you would see when you're looking at breadth across what I call market cap tiers from larger to smaller in a rotation. If this is a major market top that we're at the beginning stages of, most likely small caps would break down first, and then mid caps, and then large caps. Doesn't always happen that way, but it usually does. Why does it tend to happen that way? Because small cap stocks are a little riskier, a little higher beta, meaning they're a little more volatile, and a lot more uncertain, less proven. And so if investors, particularly institutional investors, start to get nervous about the potential for a drawdown, the potential of the market going lower, they tend to sell out of the speculative, higher beta, higher risk stuff and go into defensive, big blue chip names like Coke and Pepsi, like utility stocks like Southern, like Walmart, big box, Costco kind of retailers. And I would say in 2024, semiconductors and large cap growth like Microsoft and Apple, right? You go into proven stocks that are probably going to survive any kind of downdraft and still be okay. So pretty normal, actually, if this is a major top or if we're getting near one, that you would see the breadth turn more negative in small caps versus mid and then mid caps versus large. We may be seeing the beginning of this, and I think this is a key chart to watch over the next couple weeks, particularly as we wind down Q3 earnings. We have more economic data, we have the elections, we have the Fed meeting. Breadth data often will turn lower while the indexes are still going higher, and that can be a great red flag to recognize, even though the indexes remain strong, breadth data turns negative. So keep an eye on this chart. Again, for now, not horribly concerning. I would say the S&P 600 small cap breadth going below the 50-day moving average may be the initial sign there. Second breadth chart I'll show you today is the McClellan Oscillator, right? So this daily advanced decline line is literally just how many stocks were up, how many stocks were down, and it keeps a cumulative total. But the McClellan Oscillator sort of takes an additional step and turns it more into an oscillator. Think of this as kind of like an RSI for the markets based on market breadth instead of price momentum, right? So this is taking the advanced decline data, smoothing out the daily advanced decline trend with exponential moving averages, and then it's literally looking at the difference between two exponentially smoothed moving averages, and that's the McClellan Oscillator. I've color-coded this, and I love this way to visualizing the McClellan Oscillator because it's very easy to digest, right? Are we above the zero line or below the zero line? The main signals from my own experience would be above zero line is bullish, that's why that's highlighted in green. Below the zero line, bearish, and that's highlighted in red. Most recently here, the third week in October, the McClellan Oscillator had briefly gone above the zero line, but then a couple days later it came back down. So really since early October, for most of the month of October, the McClellan Oscillator has been below zero. So what does that mean, right? When it goes below zero, it doesn't necessarily mean end of the world negative breadth, but what it tells you is that over time, the pace of the advance is slowing down, meaning there's a narrowing of those moving averages, meaning the advanced decline data is probably lightening up a little bit. And the McClellan Oscillator usually turns below zero before you get like a big rollover in the advanced decline data, because this is almost looking at the rate of change of breadth, right? So when things start to slow down and just start to turn over at a top, the McClellan Oscillator is already coming below zero because the exponential smoothing is already rotating lower, and the difference between those moving averages is becoming narrower and narrower, and eventually going negative, and that's what this is representing. Now, if you look to the left on the chart, you can see that this is not, again, not always the end of the world. It doesn't necessarily mean that the S&P is going to go down. As a matter of fact, in late May through the month of June, the McClellan Oscillator was below zero for that entire time, even though the S&P pulled back for about a week, but then resumed its uptrend. You can also see a number of times, particularly in January, February, where the McClellan Oscillator was below zero. But the trend in the S&P was remaining quite positive. What happens and how that happens is if the largest names, if the mega cap names, the Mag 7 types of stocks remain strong enough, the indexes can continue to go higher despite the weaker breadth conditions. And that's something to remember about the dynamics of our indexes here in 2024. Those largest names still have a huge weight. The last time I ran the numbers, it's been a couple months, but last time I ran the numbers, the top 10 S&P 500 stocks, right? I think the Meta, Amazon, Nvidia types of names. If you look at the weight of the top 10 stocks, and then you start at the bottom of the S&P and start adding up the weights of the smallest stocks, do you know how many stocks you need to add up on the bottom, starting with the smallest one, just to equal the weight of the top 10? It's about 420 stocks, right? So the bottom 420 S&P names have about the same impact on the index as the top 10. That's why when Meta or Amazon or Apple or any of those names is up or down a lot, it can dramatically move the needle on the major indexes. But if 50 of the bottom names are up or down a lot, it's not going to register as much of an impact, and you might not even notice it on the chart of the S&P 500. That's how dominant those larger names are. So if theoretically everyone's sold out of all their riskier names and piled into the Magnificent Seven, the index is probably still going to be pretty strong. The breadth indicators are all going to turn negative, and we'll be waiting. And that's why part of my process always is looking at the Magnificent Seven, those big mega cap growth names, and just looking for signs of weakness there. Because if you want to know what really would tell me that the market is in for a disastrous period, it's those Magnificent Seven stocks breaking down. That's what's really going to drive the indexes lower and drag a lot of returns down with it. So, second chart here, the McClellan Oscillator, which granted is a short-term breadth indicator, has been negative for much of the month of October. And what concerns me is if there is a broader rotation downwards to be had over the next 3 to 4 weeks, this is pretty much how it would play out, right? You would have weakness in small cap versus large cap, which is what we're seeing on that first chart, looking at the cumulative advance decline lines. We would then see the McClellan Oscillator be mostly bearish because the pace of the advance in terms of breadth has slowed down and things are starting to get negative in the short term, right? Short-term deterioration is what starts and eventually could turn into long-term deterioration of any indicators, and that's why I think that's important to watch. All right. Third chart is looking at the new 52-week highs and lows. And this is something that I really enjoy, I really appreciate looking at because it talks all about market leadership, right? In a healthy bull market phase, you need an expansion in new 52-week highs, right? Think about what that means. If the S&P 500 is expected to continue to make higher highs and higher lows, you need those early leaders that are driving returns higher. You need those initial breakouts that are strong enough to start to bring other stocks along with them to this bullish party that they are throwing. So this chart from the top is the S&P 500 on a daily basis. Then we have the net difference of new 52-week highs minus new 52-week lows. And then for the New York Stock Exchange, green histogram is the new 52-week highs, just the number of stocks. And then the red are the new 52-week lows. On the very bottom, that same comparison, but for the S&P 500 index itself. You can see now that the S&P 52-week highs and lows spiked pretty strongly in mid-October, and you can see a similar spike for the new 52-week highs on the New York Stock Exchange. And notice, an almost complete absence of new 52-week lows since early September, right? So generally speaking, we've had plenty of stocks going up. What concerns me about what's happened here, in late October is look at how all of these lines are trending downwards, right? The histograms really spiked in mid-October as the S&P was pushing toward 5,900, but we stalled out and now we're lightening up. What this means is that there are a lot of stocks that were all making new 52-week highs in mid-October. At the biggest, at the highest amount, it was 115 of the S&P 500 out of the 500 names. That's around 22 to 25% of the S&P, 23% or so that were making a new 52-week high on the same day, just a couple weeks ago. Now, all of a sudden, as of last Friday, that was down to around 30 names, right? So we're down to around 6 or 7%. So there still are some companies making new 52-week highs, but a lot less. What happens at the end of a bullish phase is you have the market moving higher, and then all of a sudden the new 52-week highs start to completely dry up as things are no longer pushing upwards, and all of a sudden you're starting to see profit taking. You can see a great example of that here in like March, April of this year. We had the market making new highs January, February, March. Every month we're finishing in a position of strength. But look at this last couple weeks of March, first couple weeks of April. You can see all of these lines trending downwards, and that's because less and less stocks. Every time we're making new highs, less and less stocks are participating. Then all of a sudden it completely dries up as everything's kind of in pullback mode. So when you see the market going higher, but you see a lot less new 52-week highs, that's a concern because that means the leadership is starting to lighten up, right? There are less stocks sort of in that initial salvo, that initial thrust moving higher, and that's usually and often a sign of exhaustion. So this is an important one to watch, I would say, through the course of this week going into the elections here in the U.S. Because, again, a healthy bull market has an expansion in new highs, and I'd look to see if we can see a resumption of that uptrend. Two more breadth indicators to summarize here very quickly. This one is looking at the percent of stocks above their 200-day moving averages in blue, percent of stocks above their 50-day moving average in green. We're going to look at that bottom series, and this is looking at the S&P 500 members. You can see at the end of September, it was around 85% of the S&P stocks were above their 50-day. You can see as of Friday's close, it was around 61%. It's actually updated intraday here on Monday. So around midday Monday, it's around 60%. So what that means is a full 25% of the S&P were above their 50-day moving average about a month ago, and now we're no longer above their 50-day. So think about what that means. The S&P 500 is still above an upward sloping moving average, 50-day moving average, but about a quarter of the S&P actually have already broken down through their S&P. That's why that is a big warning sign for me. Another thing I would note is that the bearish divergence with higher highs in the S&P late September to late October, but lower peaks in this breadth indicator, which means on that last move higher, less S&P stocks were able to recover their 50-day moving average. They actually remained below it. So this is actually showing you that quite a few names are actually breaking below their 50-day moving average. Now, that's not the end of the world, right? And the long-term breadth is still fine, right? So 75% of the S&P are above their 200-day. So you're not seeing things break down a ton, but you are seeing things not go up anymore and sort of break below that initial measure of short-term trend strength. That brings us to my last breadth indicator, the Bullish percent index. I love this one because it uses point and figure charts, which is a methodology, a classic charting methodology that I think is underused and underappreciated here in the modern technical era. But, you know, back in the day when I was visiting the trading floors in Chicago, the SIBO, the CME, even the NYBOT and the New York commodities exchanges, I would see people go over and update their hand-drawn point and figure charts just to come up with key levels, key areas where they expected some action in the pits, and they would keep those levels jotted on index cards as they were making trades moment to moment. So point and figure charts really have been part of the U.S. markets for years, particularly in the commodity space, but certainly in the equity side as well. This Bullish percent index counts the S&P 500 charts using point and figure methodology. How many of them are bullish? As of Friday's close, it was 70%. As of about a month ago, it was over 80%, which means about 10% of the S&P members were bullish on their point and figure chart about a month ago and are now bearish. They've now rotated enough. They've rotated down enough to actually register a sell signal on their point and figure chart. Keep in mind, it's still at 70%. That doesn't feel that bad, but here's the problem. Look back to the left on the chart. This is looking back for the last 2 years. I've shaded in red when this indicator has gone above 70%. Look at what happens when it comes back below. In late July, we had a beautiful signal there. In early April, I'm going to skip this one and come back to it, in early August of last year, in February of last year. Every one of those times we go above 70%, we come back below. That's a great sign of a top, because what it tells you is enough stocks are selling off already that the indexes and a lot of other stocks are probably going to follow soon after. Now, I skipped that mid-January signal because it didn't work particularly well, and I would say that is the thing to remember just to wrap up today's discussion. That's what you need to remember with market breadth indicators. They are not infallible, and I wish I could tell you all you need to do is set an alert for when this goes below 70, there's your sell signal, you're done. It's just not that easy. There's a lot more nuance to things because there are a lot of other things going on, and I would say in particular in 2024, market breadth indicators I would say have a great amount of value, but you have to recognize we're in a very top-heavy market environment, which means it's also very important, besides looking at some of these, growing bearish signs on some of these market breadth indicators, also pay very close attention to the mega cap names. Identify key lines in the sand, key levels that would tell you those Mag 7 names are starting to break down. Earnings this week could give us a lot more clarity about the sustainability of the uptrends and the potential of charts like Alphabet to break out, because they really have not been particularly strong over the last 6 to 8 weeks. That's how I use market breadth indicators. Those are 5 that I appreciate using on the Stockcharts platform. As a reminder, there's a link in the description to get to my Market Misbehavior Live chart list. You are welcome to that list of charts. If you're a Stockcharts member, again, which you all should strongly consider being, you can copy those to your own login and do all sorts of cool stuff with it, along with all the other capabilities, scanning and alert and other things we don't have time to go into. But make sure you save those lists of charts. Make sure you watch breadth indicators, and more important than anything, focus on a chart of the S&P 500 and identify and anticipate signs of a downside reversal. For Market Misbehavior and Sierra Alpha Research, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great one.